Let's talk about the economy and whether or not the Fed's going to get in the way. Neil Dutta joins us, head of U.S. economics at Renaissance Macro. Neil, you've been making the case that the Fed needs to act, and we started hearing echoes of folks agreeing with you last week. And then today, I don't know, it kind of quieted down a little bit.
Well, an equity market rally will do that, Oliver. But I think it's important to remember, is a 2% rally on a jobless claims data point a sign of something good or something bad? It's
Probably
not normal.
Desperation? Does it reek of desperation?
It's not, I mean, all I would just say is that the markets are hypersensitive to every data point because if you leaving aside everything that's going on in Japan, because I think that's more of a red herring than anything else.
Okay.
Let's just talk about the last week, okay? Last Wednesday, the Fed met. Markets rallied on that day because it looked pretty clear based on the chair's press conference that they were going to tee up something for September. Then the data on Thursday weren't good. You had higher jobless claims, you had a weaker ISM, and then obviously the payroll number on Friday. So what happened, I think, is the data led to this expectation this risk that the Fed is behind the curve, okay? I mean, some people, if you recall, were talking about the Fed just sort of ripping the Band-Aid off and doing it in July, cutting. So I think the fact that the data was a lot weaker in each of those 2 days after the meeting kind of fueled a lot of these bets that the Fed was behind the curve. And then this week, we saw, I think, a better ISM services number. I think the markets like that. And then we got the jobless claims data. So really, I think the markets are still on edge. I mean, I don't think we're out of the woods yet. You don't bottom on days. You don't bottom on days like this. I'm just an economist, and I think that. But I will say it's the tone of the data that's going to really drive things. And if you get, weaker retail sales, weaker manufacturing production, maybe even weaker inflation, it'll look more obvious that the Fed's kind of stepped into it. And as I've been arguing. It's pretty easy for them to undo this. I mean, this is really just a function of tight monetary policy. That's what's going on here. And so that just means looser monetary policy can fix it.
Okay, so how much then to right the ship? How quickly does that impact start to work its way into the economy if they wait until September to start? Is there a big difference in your mind? Let's take the calendar first between waiting for September versus doing something intermeeting.
Well, I don't think they're going to do anything intermeeting because it's not like the economy is collapsing. I mean, what we're seeing unfold in the economy is this kind of slow leak of sort of air out of the balloon, which is what you'd expect, frankly, if it's really just monetary policy that's weighing on things. You kind of have this linear increase in unemployment. And I think one reason why the markets have been as buoyant as they've been is because markets are anticipating that the Fed kind of does something before a nonlinear risk really emerges. I think that's probably the right call, but I don't think the economy is falling off a cliff. And so I think that's why an emergency rate cut is unlikely. So I tend to lean against that idea. But I do think a large upfront move is probably the right move. And that's because it's not just the fact that unemployment's been rising for 5 of the last 6 months. It's also that core inflation has been slowing. And whatever inflation is right now, that represents yesterday's monetary policy. So to the extent that inflation's already been slowing, it suggests that policy is already too tight. And because the Fed sees itself as very, very restrictive, in my mind, that actually lowers the bar for a large upfront move, because even after 50 basis points, they'd still be restrictive. One of the things I found really interesting today, Oliver, was earlier in the week was mortgage purchase demand.
Okay.
We've had mortgage rates drop about 60 basis points almost over the last year. And during that time, purchase applications are down about 11%. Now, why would that be? Why would a big drop in rates still mean, weak housing transaction data? It's because inflation is also falling. Right. And that means that real rates are actually still are very elevated. So even though nominal rates are down, real rates are still high. And that's kind of weighing on housing demand.
So are you not concerned about general consumer health, spending habits, some of the pricing down we've seen that looks like they are getting a little bit more pinched? It seems like you think that's the type of stuff at this point that's recoverable.
No, I think it's concerning. But I think what I'm trying to stress is that the Fed has a role to play. I mean, what have you seen this week? You've seen a number of sell side banks raise their recession odds. Why have they done that? Because it looks like the Fed is behind the curve, right? So to me, it's really just, I would just say the Fed has a role to play. They can't just sit back and hope that things will work out. They actually have to get out there and do something to shift the trends that we're seeing in the economy, and that means cutting rates. Right now, I think the Fed and has been playing this sort of game of chicken with the corporate sector, right? So basically, the Fed sees stronger data, and they think that's a reason for them not to cut. But one of the reasons why the data has been, up until recently, has been okay, is because there's an expectation on the part of business that the Fed will cut.
Mm-hmm.
So what happens if they don't? Then you'll see, maybe hours worked going down. Maybe you start to see more of a percolation in layoffs. Obviously, the hiring rates already declined quite a bit. So, I think it's, we're in a trickier spot. And if you think about the outlook, like the near-term outlook, new home sales that have been sold that haven't been started, Oliver, that's down 35% against last year. What do you think that means for single-family residential construction? It's not good. We had a large inventory investment boost in the second quarter. That probably won't repeat given what we're seeing in global manufacturing right now. And consumer spending, if the labor markets are slowing, that means that incomes are moderating. And if incomes are moderating, I think it stands to reason that consumption is going to follow.
Neil, is the Fed then to give credit to the drop in inflation? If they need to act to repair what's going on, it seems like then you would believe that they are to credit for the drop in inflation from a year and a half ago. Is that fair?
Yeah, sure. Of course the Fed deserves credit for that. They've curbed demand, and that's cooled prices.
Okay, so if we've got the Fed so far doing a decent job, bringing inflation down, they've signaled basically their path, what they want to get to. Are there any ramifications of changing their stance before we get to those goals? Like, if we're cutting in September while we're still above their target, how much do they have to justify their ability to predict where that's going to tell the market, okay, we're going to go a little bit earlier than we might have signaled?
Well, I think their forecasts are all conditional, but I think one way of thinking about it is looking at what they have in there for they produce their quarterly summary of economic projections, right? I'm sure you're well aware of that. And if you look at what does it say for 2025? They have the unemployment rate, I think, at 4.2, and they have core PCE inflation around 2.3. And they see that as consistent with a federal funds rate of 4.1% by the end of 2025. Well, Oliver, the unemployment rate's already 4.3%. And if you look at core inflation over the last couple of months, it's basically running at 2.3%. So you could easily make an argument, and some have, that the Fed can easily justify a fairly large upfront move. And that's all I'm saying. The data are basically consistent with where they think things are going to be by the end of 2025. So, I think 100 to 125 basis points worth of rate cuts front-loaded but before the end of the year, I think that's a reasonable, baseline. It could be something like 50, 25, 25, or 50, 50, 25, something like that over the next 3 meetings.
Neil, I wonder what your thoughts are on how the market works in connection or independently. Kind of the last question here, but if we do a bit of a hypothetical, even with the pressure they were applying on the economy when you're arguing they're too tight, we were just getting some record valuations in big tech companies. Stocks were at highs. If that naturally kind of deflates, if that's moving away from the Fed a little bit, specific to some of this secular stuff, how does that factor in? Does that then limit the potential for the economy to bounce back? Or do you think stocks generally hold in if they start cutting?
I think that stocks probably will do fine if the Fed starts cutting, provided that the economy is continuing to expand, which I think is a reasonable baseline expectation. So my sense is that stocks would be okay. I think you could make an argument maybe about the kinds of stocks that would do well.
Sure.
If you have like more of a broad-based sort of growth, maybe that helps value over growth. We'll see. But I think overall things should be, that's a pretty good recipe for equities, right? I mean, ultimately, you're still talking about how much is the Fed cutting, how much is the economy growing. That's usually a good backdrop for risk appetite.
Okay. Great stuff. All right, Neil, well, we know where you stand. We'll see if the Fed goes for it. Appreciate your time.
Thanks, Oliver. Appreciate it.
Yeah, Neil Dutta, head of U.S. economics at Renaissance Macro.